Welcome to the weekend edition. My name is Peter Resnicek from ShadowTrader.net. Lots to talk about this week, obviously, not the least of which being the fact that on Wednesday we had a daily bar in the S&P that was over 11% from open to close. Just let that sink in for a second. 11% over the course of a day. Not a week, not a month, a year, but a day. So obviously we're going to get deep into the technicals, talk about that bar and why I believe it's important. It's going to actually be an important reference going forward. But more importantly, I'm actually going to spend a little bit more time than usual going over some fundamental data. As you know, all my trading decisions are 100% based on technicals. However, this week, given the stuff that's all going on, tariffs on and off, etc., the fundamentals I think matter a lot. And it's really the backdrop, obviously, that the technicals are set against in a week like this when there's been very, very heavy news flow in both directions. So in this particular program, I'm going to dig a little bit deeper into what the status is right now of the tariff situation, a little bit on the PPI print that we got on Friday that I think is important, and what the odds are for a rate cut going forward in May. And all of that to me is setting the tone for a market that I believe is about to float higher rather than lower in the near future. All right, so all that and more in today's weekend edition. Let's get into it. As always, I try as much as I can in this program to look forward, but we always begin our program with a very brief look back, which we call the weekend review. And this is where we look at the 11 sectors in the S&P, the three majors that we watch most closely, and a smattering of other things such as Bitcoin, gold, bonds, rates, etc., to see what the movement was over the course of the week from Monday's open to Friday's close. And that's important. Remember, the numbers that I'm quoting here are not from the prior Friday's close. They're from the Monday open because I'm mostly concerned with what the playable move is, I call it, as opposed to what move may have happened on a gap, right? Usually, traditional media will only talk to you about stocks and other financial instruments in terms of relationship to the prior day's close. That's what they call up or down, but I'm really not interested in that because you can't really do much with that unless you are already in it the week, or rather the day before. So everything from Monday's open here, you can see obviously pretty much all green across the board. Majors were up strong. I was saying that the S&P in the intro had an 11% move to the upside just in one day. However, Thursday gapped down a little bit, pulled in. Friday kind of took back that intraday regular trading hours action that was down on Thursday. Friday kind of took it back. So the net effect was that we were up about 8.25% from the Monday open, which is a solid move. NASDAQ up 11% on the week from Monday open, and the Russell lagging a bit at just under 5%. Just the numbers themselves here, the absolute values here, should be somewhat, shocking to you, for lack of a better word. I mean, we're talking numbers here that are usually reserved for moves over the course of a month or even in a year, right? And this is like 11% in the NASDAQ just in 1 week, which is really just kind of insane. So the volatility has really been cutting big in both directions this week. Sectors of the S&P, not surprisingly, pretty much all positive. The big winner, of course, was technology, up almost 14% from Monday's open, and that, of course, ties in very closely with the NASDAQ being up so sharply. You can see that more defensive sectors such as the utilities and maybe real estate as well didn't fare so well. Kind of makes sense, right? Because yields were up. Obviously, those are relatively interest rate sensitive sectors. So even though they were up with the market as a rising tide lifts all boats, clearly they weren't as bullish as everything else with the rise in the 10-year. And of course, the rise in the 10-year just knocked the stuffing out of bonds, down another 5% this week. I responded to someone on Twitter. You can see my handle right there if you want to follow me. I think it was last week or so, just talking about how I felt that the bond chart was just so bearish, and that was like a week ago. It was actually higher then. There's just nothing good about that chart, and I don't see any safe haven in bonds at all, and it doesn't feel like investors are crowding in there for safety at all. Really, where they're going for safety is right here. They're going to gold. Gold is up another 6.5% this week, and that trade has just been phenomenal for myself and all the subscribers in my weekly options trading room. We continue to sell puts on the futures pretty much day after day. And we also took a long on GLD for very short term from Thursday to Friday, flipped out for 100% gain on a butterfly in one day, which was nice. So everything just setting up really well in gold. Gold actually broke out to a new all-time high once again this week. And in our charts to watch section a little bit later, I'm going to be talking about gold and the mining stocks. So stay tuned for that. All right, oil was up just marginally. Oil's been kind of weak as of late, and Bitcoin was up about 7%. As you know, Bitcoin generally trades like a risk asset. And that's one of the disconnects, at least, I think that a lot of people can't seem to, get past, me included, is the fact that it theoretically should be trading outside of all this, but it really just kind of trades like a risk asset. I think when people are selling equities hot and heavy, they also unload their Bitcoin. And when they're more bullish on the market, they're more bullish on all financial instruments and they go back into Bitcoin. And we certainly saw that this week where the market's up and Bitcoin back up about 6%. So that is the week in review. We have time now for a little thing I call the fundamental take. Usually at this portion of the program, I'd be talking technicals because, of course, that's what drives all my trading decisions. And I think it's really the most important thing, is all of the information that you need to know is actually in the charts. However, this week is a little bit different. We know that the erratic moves and huge volatility were all driven by fundamental data, namely tariffs, right? Tariffs on, tariffs paused, etc. So it is extremely important to talk about, the backdrop of the technicals in relation to what's going on fundamentally. So I thought we'd just start with this fundamental take, specifically with this text here that I've copied from briefing.com. It's where I get my news from during the day. And it's just a little update on where we stand on all of the tariffs. So you can see here the following is a recap of all the tariffs currently in place. This is as of today. So we've got 10% globally on all imports, excluding energy, pharmaceuticals, and chips. However, there could be some pharmaceutical tariffs coming at a later date. This is what's important. Higher country-specific has been paused until July 9th. So that's the 90-day moratorium that the president put on all the other countries except China on Wednesday, and that's what caused the 11% move from low to high in the S&P. We'll get more into that when we look at the charts. Here's the important part of all of this is right here. 145% tariffs on Chinese imports. China then retaliated with 125% tariffs on all U.S. goods. President Trump told reporters earlier this week that he, quote unquote, can't imagine raising China tariffs beyond the current rate of 145%. And that, my friends, I think is what is the most important takeaway of all of this, and why I say that potentially the doom is over. And what I mean by that is it simply can't get any worse, right? If you think about it, we have this huge tariff in place against China. They have retaliated with a giant tariff themselves. And now these two leaders are at a standoff. You're waiting to see which side blinks first. And I believe that the longer that this standoff remains, the more bullish it is for the market, because that's essentially what the market likes, right? It obviously feeds off of indecision, and it certainly doesn't like indecision, and it does not like uncertainty, rather. But the thing is that this could go on for a while, and absent any new news on the tariff front, it feels to me like the market can't do anything except float higher, especially because understand that the market right now is still extremely short. It is very, very net short from its move from the all-time highs. And that type of a market that does not get more bad news, which is what it needs for those bears to feed on, is a market that generally will float higher, because the natural dynamic that's in place in the market is short covering, right? When you saw that move on Wednesday that was so large, that's a lot of shorts covering, right? That's immediately just like all sorts of buy stops being triggered from everybody that was short, not only from the whole move down, but in prior sessions recently before that were very, very bearish. So this is something to keep in mind. So essentially the crux of this whole video, really, if I could just pare it down to just a couple of moments here, is right here. This is what I'm talking about, is that to me, from my perspective, the tariff news in the near term, obviously things can change. Obviously, on a whim, news comes out very quickly, things can change. But at this moment, and just thinking short term for what the price action should be next week, I'm seeing the potential pretty strong for just a slow floating grind higher, if there's no new news on this front. And to me, it doesn't seem like there'll be no news on this front. It seems like both sides are just kind of digging in their heels and playing like a game of wait and see, playing a game of chicken and see who blinks. So we'll see that, all right? So that's the situation on tariffs. And again, that is the fundamental backdrop of where I feel the doom's over, so to speak, and the worst is behind us, at least in the short term. Right now, let's take a look a little bit on something a little bit more longer term. And that's going to bring us into the producer price index data that was released today. Today, I'm speaking to you on April 11th, on Friday. The PPI actually came in a lot weaker than expected. The March PPI number that was released this morning was down 0.4% against a consensus that it would actually rise by 0.1%. The prior was revised here to about flat. And the core PPI also came in down a little bit. Now, here's where the key takeaways, and this is also one of the reasons why I like briefing, because they tend to really succinctly sort of summarize everything in a very intelligent manner. The key takeaway from the report is that inflation for wholesalers was suppressed in March. However, that good news is being discounted as temporary, like yesterday's CPI report was, given that tariff actions are taking root in supply chains and are expected to lead to higher prices, at least in the short term. If you think about just that statement by itself, to me, it makes perfect sense how the market is acting right now, right? Potentially higher prices, but out there, but lower prices right now, right? So obviously the market is a discounting mechanism. It's thinking ahead, but what is the market doing, right? Think about that. Think about the three questions that I always talk about. What is the market doing? What is the market trying to do? How good of a job is the market doing getting there? Meaning, how good of a job is it doing what it's trying to do, right? So this market really is still going down. It's still in a downtrend. When we get into the charts, we'll show that obviously we're still in a downtrend. We haven't broken any trend lines. But if you ask yourself the second question, what is the market trying to do? I would say what the market is trying to do is go lower. And then the answer to the third question is, how good of a job is it doing? Not very good, right? We talked last week in the video about where the buy point would be in this market. And actually, it turned out to be very, very close to that, right? When we get into the charts, again, I'll show you exactly where I said, this is where the market is going to come into support. And lo and behold, it actually held a pretty nuanced technical support, right, of a prior high. So that in and of itself is a market that is not acting in a manner of all-out terror, right? It's a market that's actually respecting technicals, whereas to me, a more bearish market would have just crashed through all of that, right? So that being said, this makes sense to me basically, right? Is that in the near term, it seems like things are improving on the inflation front, but of course the concerns are there. And I totally understand those concerns, right? As the text here says, tariffs will take root in the supply chain and they will probably disrupt things in terms of pricing a little bit later. But for the most part, the market seems pretty sanguine about it, all right? University of Michigan consumer sentiment also came out today on Friday. And that actually came in a bit lower. It was a preliminary number, which is the important one before they do the revision. It's kind of like the first one we get. The consensus was that it would come in at around almost 55. We came in at only 50. And here's the thing. The prior for March was 57. So consumer confidence is failing. And you can see here again, they so succinctly sort of wrap it up with a bow for you. The key takeaway from the report is manifold. The decline in consumer sentiment is broad-based. Expectations for unemployment to rise are at their highest since 2009, and inflation expectations are surging. This is a terrible mix that will foment concerns about future consumer spending strength. So again, in the longer term, looking out there, things don't look so good. But my job as a trader is to make money now, and my job is to make money in the short term. That's what I do for myself, and that's what I do for my subscribers since I run a weekly options room. We deal in what is in the short term, today, tomorrow, to the end of the week, and maybe to the end of the week after that. So I have to pay very, very close attention to what the price action is doing now. As I said just a moment ago, the market is a discounting mechanism. To me, it should be more bearish if all of this is true. And it is true, but it's a question of how the market reacts to it. So the decline in consumer sentiment is broad-based. Expectations for unemployment to rise are at their highest since 2009. Well, that seems to me like it can't go in any other direction except down, right? Inflation expectations are surging. This is a terrible mix that foments concerns about future consumer spending strength. That's super important, right? The entire economy is basically is mainly that, right? Is if we lose the consumer, we lose everything. But again, What is the price action right now? What is the price action in relation to that bar on Wednesday? What is the price action right now in relation to when we made the swing low early in the week? I believe it was on Monday, right? It's all higher from there, all right? So keep this in mind. This is kind of the backdrop of everything, but what I call this is the very, very classic wall of worry, and the market likes to climb that wall of worry, all right? And again, I must reiterate to you, this is very, very important. Remember, I am a trader, not an investor. I don't care at all what's happening 3 months from now or even 1 month from now. What I talk about is what is happening right now and what I believe is going to be happening next week into the end of the week, because that is my playground. That's where I make my money. I'm not a long-term holder of equities. I don't have a bunch of money in a 401k. I could care less. I feel bad for people who do, but honestly, for me personally, meaningless. So my job is to tell you very objectively what's going on in the market and how I see it in the near term. And to me, as I said, this is climbing the wall of worry. Price action is not going down. Natural buying should take over. And most importantly, remember, you are working in the framework of a market that has been down for a long time, was down very sharply early in the week, and thus net inventory positioning is still short. People have not covered all their shorts as of yet. The market is still short, and there is still room, I think, for new money buyers to come in as well. And all of that to me points to a market that I believe should just sort of grind higher into next week. Okay, now on to the meat of the matter, as I like to call it, what's really going on, which is the technical picture, of course. So just to recap, remember last week we talked about a potential bottom at a specific area, and it actually happened right there. I was saying that the prior highs here and the breakout point here, and the S&P actually missed touching that this week by only 17 points-ish or so. So it was really right there. And again, I mentioned this earlier in the program, market acting quite technically like that is important, that technicals are being respected. So we got the bounce there off of the prior high, and you can see obviously this monthly bar of April here is not fully developed, but for now there's potential that there's going to be a huge shadow to the downside. And I've said this before, that on the longer time frames, these long tails do matter. I'm not a big hammer player. I feel that's just kind of like an amateurish thing. I remember, like, whatever it was 20 years ago or so, or whatever, when I first started reading about the markets and studying and trying to learn things, I would be looking for that hammer pattern, so to speak, thinking, oh wow, it's like the be all end all. I think a lot of newer traders fall into that trap because it's, you know, they think it's always going to work, but really I've seen that it really becomes much more powerful the longer the time frame that it is. So just keep that in mind, that if this April keeps developing this way, I'm going to pay close attention to the fact that there's this long shadow developing on the downside, which would be a bullish reversal sign on that longer time frame. All right, let's get into the dailies here on the S&P and talk a little bit about this week and how I see things going forward. So remember, everything we're talking about is against the backdrop of the fundamental, where I think that we potentially can't get any worse for the moment. And the candle that we talked about here, Wednesday being the 11% move, this is important. I think that there's an important reference to be had here at its lows and also at its highs. And what I've been saying to my group during the course of the day in my weekly options room, I've been saying that while we are inside of this candle, there's not that much that needs to be done. I think longer term traders should probably wait this out more and see if we get outside of the range of this bar. And I think below the low of this bar here is short and above is high. But that being said, I do think we float higher from there. So we probably see the high of it, because it just seems to me that Thursday was kind of a pullback. We went all the way to here. This was kind of a tricky one. I will be the first one to admit. This really kind of threw me a little bit, because the move down on Thursday was bigger than halfback. Usually my general rule of thumb is that the midpoint of a range should not get violated if that tone is to remain bullish, if that range is an expansion of range to the upside. And certainly this was one of the largest expansions of range that we've seen in like forever, basically. I don't know if there was a range this large. I'm sure there was at some point, but there have not been very many, I'm sure. And Thursday's action did come pretty deep into that range, and it definitely took out the midpoint by quite a bit. You can see the midpoint of the range just kind of visually would be about here, and we took it out quite a bit. But then the sellers on Friday were not able to get any traction at all. really. And you can see we just kind of lined up these two bodies here where from what was one close to open in the prior day was the open and close of the next day. So looking a little bit more bullish in the short term, which leads us to a couple other technical points that are important here. The market is now closed a bar above the 8 EMA, and it's done that twice actually. It did it on Wednesday, and then you had the Thursday pullback, so now it's done it twice. Noteworthy, carry that forward. The market is also now sitting right under a secondary downtrend, which is right here, as you can see. That's from here. That's important because I feel that any move above this that closes a daily bar here probably increases the odds that you float up at least to here, to about the 54.80 area. And again, reminding of what I said earlier, I'm a trader, not an investor. So I'm thinking about just next week. This is the short-term outlook of where it seems to me that things should go. When trend lines break, the natural occurrence is to move on the other side of the trend line and move forward, should be there. This little move is actually extra interesting to me because not only do we have a near-term target, which is the primary line, but we also have the prior lows here that are tying in perfectly with that, right? So that's probably an area where the market wants to go. It'll get pulled up to that old support, which will of course become new resistance, and then we will just reset our expectations from there. It's that simple, right? If we get the move that I'm expecting, which is the float to there, that's also a 21 EMA there, we come to here, again, we just reset from there, look for probably a pullback, and in that pullback then be watching very closely for what price action does in relation to the next trend line, right? That's called a signpost, right? I talk about that a lot in my pre-market perspective, which is the daily video and report that I put out every single morning, 30 minutes before the open. Address is right here in the Chiron, shadowtrader.net/PPP, if you want to get that every day. Right, the signposts are generally, could be market profile nuance, could be prior highs, prior lows, support or resistance, could be trend lines, could be exponential moving averages, whatever. We cross one signpost and we look to the next one. So again, coming forward, there's potential that we get to the main downtrend, which would be here all the way from the late February highs. And that, of course, is important as well, because what happens after that, play it forward. If by any chance we do get a daily bar close over that, well, guess what? The bear market is over. I don't care how you slice it. You can, disagree all you want. The trend line is the thing. It is law. Once that line is broken, the market is no longer in a downtrend. End of story. It could still be well below, percentage-wise off from the all-time high, but it is no longer in a downtrend. So just something to keep in mind. And that's really not that far away, if you think about it, to get from here to there. All right, let's briefly take a look at NDX. Not much different, really. You've got the same prior lows here, potentially coming into play here. You got a ways to go to get to the top of the big Wednesday candle. And this one's just a little bit different in that I don't really see the primary and secondary. I mean, theoretically, you could say there's a secondary trend line here, but it's extremely steep. You could set it probably from this high, maybe connecting. Not really. I mean, it really doesn't even make sense. You can't really even connect there because this high here came too close to this trend line to really set it up. So really, it's just the prior lows where I think that the NASDAQ 100 will be pulled to, and those prior lows are tying like right in with that downtrend line. So it's going to be kind of a very interesting price action next week, floating up to that level right around the 19,000, which is also a big whole number psychological pivot, and we'll kind of take it from there and see what happens going forward. Now, before we get off these charts, I want to show you one other thing here that I think is noteworthy, at least it is a data point, is the fact that remember what these charts look like as I switch from these to the dailies of the futures instead, remembering that the futures trade 24 hours and the charts you see here are only 9:30 to 4 p.m. Eastern, right? So let's go to the ES, which would be ES M25. And I just wanted to show you how it's kind of an interesting, very different picture in that because it's a 24-hour chart, correct? Look at the nature of this bar, like where it starts and comes down here as opposed to the cash is just inside of here, right? So I think that's kind of noteworthy. And it's also interesting to me that in the futures market, we opened, this is where we closed on Wednesday. Thursday opened here. You've got some equal highs here, basically. And it all just kind of ties in perfectly with all the prior lows. So same thing in, in the futures market, any strength, this is going to be a really key area to resolve in the ES. If you're a futures trader, and many of you are on an intraday basis exclusively, 5,600 is a really key level. So do not forget it. It's very, very important. You've got prior lows there and some prior highs. It's all kind of wrapped around that section. So again, I think that's really the key level going forward. Let's take a look at NQs for a second. I would say that key level is right here at the low, is about 19,350 area. And again, same thing where you've got the prior lows, some congestion, and then look at these two highs. They stopped right there, very, very technically. Even as powerful as that day was on Wednesday, it could not get through that key technical resistance of those prior lows at that area. Okay, time now for the charts to watch section. And this week, I think the chart to watch is gold. This has been a great trade in all of 2025 with all of the upward movement. As I've mentioned many, many times, my MO here is to sell puts on the futures. Gold futures have options of their own, and I think they're pretty lucrative. You can find premiums on the put side quite far away for 80 cents to $1.50 or whatever. Obviously, it's better to do on a pullback. That's even better. So usually I try to time that with a pullback, but it's pretty much good almost all the time if you've got a good feel for the technicals and where supports are coming in. So this week we saw a huge move in gold to the upside, pretty much up 4 out of 5 days here, Tuesday, Wednesday, Thursday, Friday, just kind of straight up. So the next thing you want to be looking for in this chart, you can see I already have a limit order for one contract on the futures to start building a position at the prior high. That's just a classic, trade setup, I should say, right? That the old resistance will become new support. So potentially there. Put sales are anywhere here on the 8 EMA or the 21. And of course, this also affects all mining stocks. If you like that better, you might want to be interested in GDX, which obviously had a breakout. I think all pullbacks are going to be viable, and within GDX are all of the usual suspects such as NEM, KGC, AU, GOLD, etc. All the mining stocks could also be long on pullbacks or short those puts, so something to think about there. Also tying in with this sector is silver. Silver has been showing relative weakness. This is typical that silver will not rally as much as gold, but it's very, very hard for silver to become disconnected from gold. So I think that the next move here is that silver is going to make an assault on the prior highs in this 32 area right here sometime soon as gold keeps on rallying. And if you move out to a weekly here, I've put a channel line here from these highs, and this is actually where I think that silver is going to go. I think that if silver can get over this area of the 32, you're going to see a move here closer to like 34, 35-ish. So that's also something to keep in mind. These charts to watch that I talk about in this section is basically just things that could be happening in the future, stuff you want to be aware of for potential trades. And again, I think the metals and mining is definitely in play right now. This is really the classic wall of worry trade, similar to what I was talking about in the equities, that I feel that equities are going to float higher from here. But remember what I was saying is that the feel out there, as we were looking at those comments from briefing.com, is that yes, there's still going to be some wrench thrown in the works as far as supply chain and as far as prices going forward, etc. All of this is slowly inflationary in the bigger picture, even if it's not so much in the very short term. We had that PPI print come in weaker, right, signaling that producer prices were actually coming down. But again, the powers that be, or I should say, people that are really steeped in all this economic stuff and really follow it closely, they all feel that this is potentially transitory, right? And that the higher prices are coming on down the pipe. And gold is the antidote for that. Gold is basically a hedge of two things. Gold is a hedge on inflation, and gold is a hedge on uncertainty. And certainly we have a lot of uncertainty right now, and that's why you saw gold so strong this week. All right, so keep all that in mind. These trades are probably going to be buys on pullbacks or short puts, however you want to look at it, probably for the rest of this year. Time now for the number one draft pick, which is where I always want to leave you with one really good idea that you can put to work as early as next week. And this week it is Google, one of the Mag 7, Fangman plus T, however you want to call it. The stock is showing some strength here. Doesn't look that different from other charts out there, but in a way it is, because I believe the stock is about to break its downtrend. These are the February highs, just like everything else in the market, and it ties in with here. And look at where we are now. We're testing that downtrend line, which is not something that the market can say right now, and not something that a lot of other stocks can say right now. So this is kind of noteworthy. We're also above the 8 EMA here, and we're testing the 21. And notice that the last few sessions have tested the 21 3 times. That's relatively rare that 3 sessions would come right up against the 21 EMA and not break yet. So I think the next move should be higher. It should float from here. I don't really have a target on it. I mean, I'm obviously kind of a short-term outlook type person, so I would be thinking maybe just to the next signpost here, which is the 170 area. This is a classic type of pattern, I think, that would work well for a calendar spread where you may be long something further out in time and short options that are closer on the call side. Potentially, it could even work as a covered call, to be honest with you. You'd have to check the vol, which is probably relatively elevated right now, so that might be okay, because obviously you want to get more implied volatility, get more bang for your buck. I'm not the biggest fan of that strategy, but I'm just putting it out there that any stock that has the potential to grind sideways to up from kind of a lower left to upper right in a relatively slow manner, that's the type of stock you'd want to be looking for a covered call. Me personally, I like butterflies, I like complex spreads. I'd probably be looking at this for next week with something like a 160, 170, 180 butterfly. Maybe even a ratio spread 160, 170 or something like that. I'm a big fan of complex spreads and trying to be net short options as much as I can so that I can place those directional spreads for as little cash outlay or debit, if you will, as I can. All right, if you want to learn more about that strategy, I've been employing it successfully for many, many years with my subscribers. Check this link right here in the Chiron. It's also in the description below, shadowtrader.net/options. You can trade live with me every single day. I'm live in the room for about 2 to 3 hours and sharing all my trades in real time. You can also take a $7 1-week trial to that right at our website. So again, shadowtrader.net/options. All right. Now, that being said about Google, let's do a little quick look back on Nike, because Nike was the #1 draft pick last week. It hasn't done much yet, but it hasn't really collapsed all that much either. I'm very interested in this range. The reason I wanted to kind of go back to this and recap it is that if it's not a buy here, at the very least, it will set up to be a buy once this consolidation area is broken. It's like a perfect box with so many highs and lows almost equal. So if you can get out of that box to the upside at some point, it's got a gap to fill to the upside here. There's another gap here. So there's plenty of technical stuff that needs to be corrected up there. And of course, as always, you're going to be watching to see if any of those breaks to the upside set up a trend line break, right? So like right in here is your downtrend in Nike, and we'll see. And I would think the target has to be at least here to about the midpoint of the range, about 60 to 70. But like I was saying, I kind of like this right now. This is, of course, on some uncertainty here. We'll see what happens with the tariffs. If it comes back into play with Vietnam, Cambodia, etc., places where they do some manufacture, could be problematic. But again, definitely one to watch, I think, at these very depressed levels in Nike, and also just this sort of consolidation around the lows that I think could lead to higher prices on a break. And that's my show for this week. Thank you, as always, for spending a little bit of your weekend with me. Before I get into the recap, I want to issue a very sincere thank you to all of you, the viewers, because last week's video was viewed by over 153,000 people. So thanks so much for that. We caught a lot of traction with last week's video, and that also put our subscriber count very close to 100,000. So we're excited to maybe be breaching that level this week. So if you're new to the channel, please hit the like and subscribe buttons if you could, and also the bell icon so that you can get notified whenever Shadow Trader posts new videos. All right. As I was saying, the TA is firming here and looking a little bit more bullish than bearish to me. But most importantly, why? Because it's against the backdrop of the fundamental news that's out there, which to me can't get any worse. I think this is probably as bad as it can get. And with the tariffs on pause here on everybody except China, and China and America kind of in this stalemate now, just kind of in a wait and see to see who blinks first, I think that the natural dynamic of short covering is what's going to take over in this market, and we should see somewhat of a float higher into next week, all right? That next week is going to be a shortened week. Just remember, markets are going to be closed on Friday in observance of Good Friday. That means that I'm going to be speaking to you sooner rather than later, so I'll see you on Thursday night next week, all right? Until then, on behalf of myself and the entire Shadow Trader team, coming at you from beautiful Los Angeles, California, as always, I wish you good trading and good night.